Today, the bears are in charge. Hello again, it's Martin North from Digital Finance Analytics, World Notice Post, covering finance and property news with a distinctively Australian flavour. Well, the Dow slumped on Wednesday as a sell-off in tech and a plunge in target shares followed weaker than expected quarterly results, and that triggered a sell-off in retailers that pushed stocks to their biggest one-day loss since 2020. The Dow Jones Industrial Average slipped 3.57% to end at 31,473. The S&P 500 fell 4.04% to 3,923, and the Nasdaq fell 4.73%, down more than 26% on the year, to land at 11,418. A slump in stocks is set to continue in Asia on Thursday, after mounting fears an economic slowdown hit US shares and spurred a flight to havens including treasuries and the dollar. Futures signal declines in Japan, Australia and Hong Kong in the wake of the plunge in the S&P 500, the biggest daily drop in almost 2 years. Earnings reports from consumer stalwarts stoked worries that high inflation is weighing on margins and consumer spending. Target plunged the most since Black Monday back in 1987, a day after Walmart also spiraled lower. US consumers are shifting their spending from merchandise to services, a worrying trend for retailers that spent the past 2 years profiting from a pandemic spending binge. Disappointing quarterly numbers from retail giants Target and Lowe's are striking fear into the market, said Fiona Cincotta at City Index. The data yesterday suggests that consumers are weathering the inflation hit for now. Retailers, however, are not doing so well as navigating through soaring input costs. Federal Reserve officials reaffirm that sharply tighter monetary policy lies ahead to cool economic activity and to get prices under control. Chicago Fed President Charles Evans said raising interest rates somewhat above the neutral level and stopping there should help bring inflation down. And Fed Chair Jerome Powell said on Tuesday that the central bank would keep pushing interest rates higher until the pace of inflation cools. These are gloomy forecasts from central banks, with even the Fed now targeting a softish landing, which feels very much like a stage before a mild recession, said Craig Erlam, analyst at online trading platform Onya. It may be time to buckle up and prepare for a very bumpy year. Goldman Sachs Chief Executive Officer David Solomon said clients are preparing for slowing growth and the decline in asset prices, all as extremely punitive inflation creates a tax on the economy. There's a chance of a recession, he said, but he added that he's not overly concerned about that risk, citing around a 30% chance of such an event in the next 12-24 months, as calculated by his firm's economists. And he's watching closely for whether credit spreads begin to widen out more materially. The search for refuge amid fraying risk appetite saw treasurers rally and the yield curve flatten, while also bolstering the dollar, the yen and Swiss franc. Gold was stuck though at around 1,814, while silver slid slightly to 21.35. The 10-year US Treasury was below 3% at 2.884, and the 2-year was at 2.667. The challenges from inflation for bellwether retailers weakens the argument that corporate earnings can help stem this year's rout in stocks. Instead, global equities are sliding towards a bear market as recession fears mount. We are pricing in a growth scare, Laurie Casavea at RBC Capital Markets said. The market is trying to find a bottom here. There is a lot of uncertainty in this market right now about whether or not that recession is going to come through, or if it's going to be another near-death experience. Target Corporation fell more than 24% after reporting first quarter earnings that fell well short of estimates and cutting its guidance on margins, citing ongoing cost pressures. Lowe's also contributed to the gloom, falling 5% after reporting mixed quarterly results as revenue and comparable store sales fell short of Wall Street estimates. The quarterly results sparked a sell-off in retailers with Walmart, Costco Wholesale, and Dollar Tree all down sharply. TJX companies bucked the trend lower, however rising more than 7% after the discount retailers' quarterly profit topped estimates. Big Tech pegged some of their gains from a day earlier also, as investors continued to mull the prospect of the Federal Reserve turning more hawkish on monetary policy tightening. Amazon and Apple led Big Tech lower, falling more than 7% and 5% respectively. Treasury yields, meanwhile, struggled to advance, pressurised by safe haven buying as investors remained concerned about slowing growth amid policy tightening from global central banks. But oil prices fell 2.5% on Wednesday, reversing earlier gains as traders grew less worried about a supply crunch after government data showed US refiners ramped up output and as crude futures followed Wall Street lower. The global crude benchmark has lost 4.5% in 2 days of trading after rising about 12% in 4 prior sessions that took it to a 1-month high of 114.79 on Monday. Brent crude settled down 2.5% at 109.20, and US West Texas Intermediate fell 1.34% to 105.64. Both benchmarks gave up early gains of $2 to $3 a barrel following a change in risk sentiment as equity markets fell, said UBS analyst Giovanni Stuaveno. Brent remained at an unusual discount to WTI a day after settling below the US benchmark for the first time since May 2020. Traders and analysts cited strong export demand and tightening US crude stockpiles. In fact, crude inventories in the US fell by 3.4 million barrels last week, an unexpected drawdown as refiners ramped up output in response to tight product inventories and near-record exports that have forced US diesel and gasoline prices to record highs. Record high prices of fuel. Gasoline, in fact, was above $4.50 per gallon at some US pumps, and diesel at over $6. And of course, that's feeding through to accelerating inflation and could eventually lead to demand destruction in energy as consumers find it increasingly hard to pay such prices. In fact, though, US gasoline prices fell 5% just 2 days after touching that all-time record high. Capacity use on both the East Coast and Gulf Coast was about 95%, putting those refineries close to their highest possible running rates. While on the face of it the report was extraordinarily bullish, the refiners are racing to put more refined product on the market. There's obviously a refiner's response, said John Kidloff, a partner at Again Capital. The perception that we could see some more supply coming out of Venezuela coming onto the market, along with the equity markets, it's causing some profit-taking in a much-needed technical correction in the crude, said Dennis Kisler, Senior Vice President for Trading at BOK Financial. The European Union's failure so far to persuade Hungary to lift its veto on a proposed embargo on Russian oil was adding price pressure, although some diplomats expect agreement on a phased ban at a summit at the end of May. And in fact, there was more positive news on that front yesterday as well. Ongoing supply concerns remain supportive. Russian crude oil output in April fell by nearly 9% from the previous month, an internal OPEC Plus report showed on Tuesday, as Western sanctions on Moscow curbed exports. On the demand side, hopes of further lockdown easing in China boosted expectations of recovery. Authorities allowed 864 of Shanghai's financial institutions to resume work, sources said, and China has relaxed some COVID test rules for US and other travellers. Halliburton Company, Marathon Oil Corporation and APA Corporation were among the biggest sector decliners, with the latter down more than 6%, thanks to the slide in oil prices. On the economic front, housing activity in the US continues to slow in the wake of rising mortgage rates. Housing starts, a gauge of US home building, fell 0.2% in April on the month to a seasonally adjusted annual rate of 1.724 million. And the point is this, that while the stock markets may well be easing down, if the housing market starts to ease back, that could change the calculus ahead. Meanwhile, in the UK inflation soared to 9% in April. That's the highest level in more than 40 years, as the rising cost of gas and electricity pushed household energy bills to record levels. The escalating cost of food and transport also contributed to the rising cost of living, deepening the crisis affecting millions of low and middle income families. Business groups said all sectors of the industry and commerce were suffering from the steep rise in energy and fuel costs, with many facing a similar shock to their finances as seen during the pandemic, but without the same level of government support. The Office for National Statistics said the 54% increase in the energy price cap in April, which took the average annual gas and electricity bill close to £2,000, was the main reason for the jump in the consumer price index from 7% in March. Average petrol prices rose to a record 161.8 pence a litre in April 2022 from 125.5 pence a year earlier. Diesel was another factor behind the increase in the consumer price index from 7% in February after the average cost at the pump hit a record high of 176.1 pence a litre, leading to an average increase over the last 12 months in motor fuels of 31.4%. A steep fall in the value of the pound on foreign exchange markets piled further pressure on businesses by adding to the cost of imports. Sterling has slumped since last month from more than $1.30 to $1.24 after hitting $1.22 last week. Food banks have reported an increase in demand for food packages after the rise in energy bills, while many small business owners have said a combination of higher costs and tax increases pushed them to the edge of bankruptcy. In fact, figures from the Resolution Foundation showed the poorest tenth of households face an inflation rate of 10.2% in April, significantly higher than the 8.7% affecting the top 10% of earners. The Institute of Fiscal Studies think tank suggests the inflation rate experienced by the poorest households could be closer to 11%. And predictions that high inflation and a shortage of skilled workers have already begun to push the UK economy into recession are expected to add further pressure on the Chancellor to offer further support to households and businesses. Bank of England policymakers are expected to react to the figures at their meeting in June by increasing interest rates for the fourth time since last December to 1.25%. And labour market figures released on Tuesday showed that average total wages increased by 7% in March, pushed up by bonus payments to staff and consultants working in the finance, IT, construction and professional services sectors. However, income growth has not been evenly distributed. The average pay rise without bonuses was only 4.2%, hitting millions of workers with a fifth consecutive month of falling real wages. As a result of all that, the FTSE was down 1.07% to 7,438. Now, over in crypto land, Bitcoin open interest, the total number of outstanding derivative contracts that have not been settled, has been on a downward trend recently. That's not surprising given that the price of the digital asset has been declining in recent times. The past week has seen this downtrend mostly driven by movements on the crypto exchange Binance. What this paints a picture of is an unstable market. With liquidations rising in recent times and open interest plummeting, it shows most negative sentiment on the part of traders, as even open interest has had a hard time maintaining a simple course either upwards or downwards. And Bitcoin was at 28,792, down 5.42% at the time of writing, while Ether was down 8.36% to 1,915. And as noted in an opinion piece on Bloomberg today, Bitcoin and other cryptocurrency assets are notoriously volatile, routinely suffering large drops of 50% or more. This doesn't seem to bother the die-hard believers in crypto too much, who have become used to declines of this magnitude. They simply use the declines to buy more. Even so, there are still a lot of people in the space who remember the crypto winter, which was the period between early 2018 and mid-2020, when prices went down and stayed down, and much of the innovation in crypto came to a halt. In previous crypto bear markets, people wondered if Bitcoin would rebound, but now they wonder out loud about the future of blockchain in general. There should be no question about the unlimited potential of the technology, but if you own a basket of crypto today, it will probably be worth much more in the future. But how much more and when is the question that nobody can answer. Crypto will have another winter, but out of that neglect, they said, will grow another bull market led by a handful of cryptocurrencies that will grow to far beyond what exists today. Maybe. And meanwhile, Treasury Secretary Janet Yellen confirmed it's unlikely the US will allow Russia to continue making bond payments in its foreign currency debt, as investors have had time to adjust to Moscow's exclusion from the global financial system for the war in Ukraine. But what damage will be done to the US economy and global markets before the Fed changes tack and eases policy again is, of course, the really big question. They will lift those interest rates, but the consequences and fallout will be quite extreme. And maybe now the markets are beginning to wake up to 1, rates will go up, and 2, prices will fall. This is a time for the bears. And how long? Nobody knows. But I wouldn't be surprised to see bear activity continuing certainly well through the second half of the year and into September and beyond. It's worth remembering that, in fact, September is often a really tricky month for markets when people come back from their northern holidays. So it may well be that we will continue to grind lower and then drop further then. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.